The film going? Okay, recorded. Okay, welcome everyone. Um, our very capable organizer is traveling today, so couldn't join us. But welcome to you all. Our moderator today is Holly Hay, and I pass it over to her to run the show. Thank you, Holly.
Thank you so much for the introduction, Dr. Penman, and welcome everyone to the Accounting Design Project virtual event. My name is Holly He, and I am Assistant Professor at Cal Poly Pomona. It's my great honor to moderate today's session. And today we have Dr. Henry Laurion from University of Colorado Boulder. He will be presenting his paper, When is the Lack of Goodwill Impairment Informative? Just a few housekeeping rules before we start. So for the audience, please open your camera to ensure an active engagement of our virtual meeting. If you have questions, please either raise your hand by the raise hand function in the Zoom or type your question in the chat, and I will call your name in order. And please mute yourself if you are not asking questions. So Henry, you will have the first 5 minutes uninterrupted, and I will give you a reminder when we move towards the last couple of minutes. Now the floor is yours. And just to make sure, Alicia, we are recording this meeting, right?
Correct.
Okay, thank you. Now floor is yours, Henry.
Thanks, Holly, for that great introduction. And no 5 minutes is needed. So if you have a question on an early slide, feel free to either stop me or raise your hand, and I'll try to keep a track. I've got everybody's face over here on this side, so I'll try to keep track of that as I go. I've got my laser pointer out here, and the title of my paper is When Does the Lack of a Goodwill Impairment Reflect Managers' Private Information? It's written with myself, Scott Robinson, who's an assistant professor at University of Oregon, and Francis Tice, who's also at CU Boulder. This is my agenda for the day. I love to go through cases, so I'm going to just go through a case where a non-impairment I thought was informative. Then we'll talk about the motivation of the academic study that we do and the prior evidence that we relate to. I'll talk about the design of our tests, and then finally we'll get to the results. First, the Digital Globe case. This was a case that was written by myself and Alistair Lawrence back when I was at Berkeley, and it was a real-time case. So this was in 2016 when we wrote it. The 10K had just come out and they declined to recognize a goodwill impairment. Here's the balance sheet of Digital Globe. Digital Globe has satellites in space that take pictures of the Earth, and they sell those pictures. So you can see their big PP&E balance there, which is their satellites. They've got a book value of common equity of 1248.1 here. And they've got goodwill on their balance sheet of 484.1. Okay, on this plot is the stock price in a black line and the book value of equity as a red line. And so you can see that the stock price dipped below book value. And at the time of the 10K disclosure, the company had a market to book ratio of 0.77. So the market value was below book value. And they elected not to impair goodwill. Here's their disclosure on their impairment test. The company determined the fair value of its single reporting unit using a discounted cash flow analysis, which requires the use of significant judgments and estimates. Based upon the valuation performed, the fair value of the company's single reporting unit exceeds carrying value by 35%. In order to further assess the reasonableness, we corroborated the valuation with market-based information, comparable public company trading values, values observed in business acquisitions, and those supported the fair value determination. So no goodwill impairment is recognized. And Alistair and I thought that was a particularly strong signal, flashing back to this slide with a market to book ratio of 0.77. Not only was management not impairing this red line, this book value, but they were saying, actually, we think the fair value is 35% higher than that line. And so we thought that was an interesting case in real time to examine whether investors are correct about the value of this company or managers. Yeah, Sudipta.
So the question is whether they should have impaired at this point, because the impairments are supposed to be impairments for permanent impairments, or what's called other than temporary impairments. And is a 3-month decline in the stock price below 1 sufficient evidence of a permanent impairment or other than temporary impairment?
No, but it was enough evidence to trigger the goodwill impairment test. And they concluded that
Well,
no
it's the
impairment was.
annual test is sort of mandatory, right?
Right, true.
So
Yeah,
it
I guess
doesn't
that's
trigger,
true.
didn't trigger anything.
Okay, so yeah, I suppose that was the reason. Maybe you could say that's the reason they didn't record a goodwill impairment, is because they considered this a temporary decline. I agree with you.
I mean,
I
that's what
do.
you're going to show us later, right?
Yeah.
So,
So here's the subsequent performance. 10K came out and the market value is below book value, and the market value recovered, and pretty much at the quarterly earnings announcements is when we observed most of the recoveries happening, where the market price eventually exceeded management's fair value estimate. So just to preview our design, we were interested in this case. I was kind of taught growing up in academic research that when the market value dips below book value, there's kind of an idea that there's a non-discretionary impairment there, and managers might at least be inclined to test goodwill for impairment and recognize an impairment. What we're doing in the study is we're interested in how frequently does stock price recover for firms that have goodwill on their balance sheet and decline to recognize a market implied goodwill impairment. And so this is the basic design of our sample, where the market value is a black line, below book value, the red line, at least 5% below book value. What we're going to test is this dotted line shows you how the market value recovers above book value within a year after the balance sheet date, where a market value was below book value. We're also going to test the market's reaction to goodwill impairment when the non-impairment is announced. Okay, just to talk about motivation for a minute, there's quite a lot of prior academic evidence on this type of research question. So first of all, Romana and Watts, which is a very well-cited paper on goodwill impairment decisions in companies that have sustained market value below book value. Now, they tested whether the impairment decision can be attributed to managers' private information on positive future cash flows, and they found no evidence to confirm that story, and I'll talk about their evidence later. Lee, Schroff, Venkataraman, and Zhang, 2011, what they examined was when an impairment or non-impairment is announced, how does the market react to it? And their conclusion is our analysis of firms with potentially impaired goodwill who report zero impairment show that market participants do not revise their original expectations regarding impairment at the time of the revelation of zero impairment. Some reason to believe that non-impairments could be informative, though, come from practitioner comment letters and just some institutional factors. So practitioner comment letter by Bank of America, when the FASB was considering changing the accounting for goodwill, they mentioned if an entity did not incur an impairment during times of stress, some might view that as an indicator of strength of the underlying business and the continued success resiliency of the post-acquisition operations. Another comment letter, when no recognition of impairment occurs, information is also conveyed that fair values have either been maintained or have increased in value. In addition to some practitioners saying that it could be a useful signal, there's some market factors at play too. This is the goodwill impairment decision is heavily scrutinized by auditors. It's frequently the subject of a critical audit matter or a CAM. SEC comment letters are frequent in companies that conduct goodwill impairment tests. Investors and analysts can also be monitors and constrain opportunistic behavior, which would be the non-impairment of goodwill. I'll start with the Romana and Watts evidence. So they concluded that there's no evidence that non-impairments are driven by private information on average. And that's fair enough, okay? So on average, that could be true. Their empirical design was to predict the magnitude of the impairment as the dependent variable. And they tested to see whether future buy and hold returns over the next year is associated with the decision to impair goodwill at the beginning of the year. So the hypothesis would be that if returns are significantly positive, first of all, let me tell you about their sample, which is these are companies with 2 years of market value being below book value of equity. And these firms either do or do not impair at the end of that 2 years. their hypothesis was, well, if the firms that didn't impair have higher subsequent returns than the firms that did, that suggests that the non-impairment decision was based on positive private information of future returns. So what I've highlighted in yellow here is an insignificantly negative coefficient. Now, they were expecting it to be negative. The higher the future returns, the lower the impairment. But it wasn't significant. So they concluded that they don't have significant evidence that this non-impairment decision is based on positive private information. So that was their test, and that's the first bullet point here. But there's a recent working paper by Chen, Schroff, and Zhang, which examines firms that impair goodwill unnecessarily, which is firms sometimes impair goodwill even though the stock price subsequently increases. And that creates a problem comparing impairments to non-impairments. So our takeaway from the fact that Raman and Watts didn't find an association between the impairment decision and subsequent returns, if you combine that with the fact that some firms impair even when it's unnecessary. So consider two firms, firm A and B, that are identical. They both have depressed stock prices, both due to misvaluation. Firm A recognizes an unnecessary impairment, and firm B relies on their private information and does not recognize an impairment. Both may experience similar future positive returns, even though they have different impairment decisions. So same returns, but the different impairment decisions. And I'm going to get to the question real quick, but that could be why there is no average relationship between future returns and an impairment decision. Yeah, Sudipta.
So what's unnecessary impairment?
That's when if Digital Globe said, well, our stock price is, our market to book is 0.77, let's impair 33% or 23% of our book value. Even though they might possess private information that stock price will recover. So that's what this working paper is suggesting, that firms sometimes, when the stock price drops below book value, they impair unnecessarily.
I thought your argument was that you brought up trend that anytime the price falls below book value, you should trigger an impairment. So what is unnecessary?
You should test for, yeah, that's what I was trained, but I think what I should say is you should test for impairment.
Okay, so how do you know that it is unnecessary then? If it's tested, the auditors have signed off.
Well, I think this paper, so not to get too far into the details of this paper, but I think what they observe is stock price recovery after an impairment.
But again, stock price is not forecastable unless you have private information.
Exactly.
So it's not clear that it's unnecessary.
You're right. It's not clear that it's unnecessary. It's just suggestive. I believe it suggests it, but I agree with you. It's not conclusive. But basically, our takeaway from these two papers is that we wanted to develop a firm level measure. As imperfect as it may be, we want a firm level measure of justified non-impairment because we don't think it's exactly fair to compare impairment to non-impairment firms for this reason. Okay, the next academic paper is Lee Schroff, Venkata Raman, and Zhang, and they examine the market response to non-impairments. So the coefficient I have highlighted here is the market response to a non-impairment. And what you would, and their impairments are stated as positive values. So what you would expect to a non-impairment is a negative coefficient here. If there's a negative coefficient in this yellow highlight here, what's happening is that the market observes no impairment, even though the firm looks similar to a firm that did impair. And when the market observes no impairment, the stock price goes up. That's what we would conclude if there was a negative coefficient in that yellow highlighting. They conclude that our analysis of firms with potentially impaired goodwill who report zero impairment shows that market participants do not revise their original expectations regarding impairment at the time of the revelation of zero impairment, especially in the current standard setting period that we have. Okay, so our takeaway from this paper is that based on our framework where the market value is a key input to deciding whether an impairment is necessary, the control firms that they're using in this sample, so this is the control sample here, And the book to market ratio, the median non-impairment firm in their sample has a book to market ratio of 0.6. And that translates to a market to book ratio of 0.67. Well, in our framework, those managers weren't really strongly thinking they should impair goodwill. They're not receiving a strong market signal that goodwill should be impaired in our framework. And so we're not surprised that investors don't react when none is recognized. So we explicitly make our sample construction to be firms with market value falling below book value, so that it's more likely that investors are surprised when an impairment is not recognized. So again, here's our sample design. We select companies with market value falling 5% at least below book value as of the end of the year and as of the earnings announcement. And then what we do is we track stock price performance in the year following the disclosure of the 10K. We base one of our main variables is called recover, which is if the stock price recovers. Yeah, Sarita. Oh, can't hear you. Could you unmute?
Sorry, why did you pick the 5% benchmark?
Okay, so this felt right. It felt low enough that it would trigger a consideration for goodwill impairment. And in fact, when we look at our sample firms, we don't find any examples of companies that don't do a goodwill impairment test at this Q4 time period.
But Q4 is mandatory anyway, so I don't see that's evidence.
Well, it's not required at Q4. It's just required sometime during the year. Okay. That's my understanding, at least. You could do it at Q1, for example. You could have your annual impairment test at Q1. But I think probably you're right that most companies
for the
do
annual
Q4.
report, you can't do it in Q1. That would be meaningless. Because
so yeah, maybe somebody could clear up my understanding, but my understanding is you can select any date during the year to perform your annual goodwill impairment test. And
anytime you have information that suggests goodwill is impaired, that's true.
And then there's also triggering.
That doesn't take away.
Exactly.
The auditors need to certify that the balance sheet on the end of period date.
You're right. I agree with you. There's definitely going to be some sort of a roll forward
impairment test regardless.
Okay.
In Q4.
Yeah, fair enough. So anyway, the reason we selected the sample, we wanted a low enough market value to, we think, trigger a serious impairment test. And we also wanted a reasonable sample size. So as you go lower, your sample size gets smaller. So that's why we selected 5%. So we look at this recover variable, which equals 1 if the stock price recovers within the next year following the 10K. We also observe market response to the non-impairment announcement. Okay, so our first test, since we have this, what we think is a firm level measure of whether the non-impairment is justified. So every company in our sample has market value below book value. The question is, does their stock price recover? And so now we need to look at some cross-sectional variation. Who do we expect to be doing better goodwill impairment tests than others? So what we do is motivate ex ante factors that we think might identify firms that perform more reliable impairment tests. And then we test among firms with depressed equity market values, whether firms that perform more reliable impairment tests are more likely to have stock price recovery. I saw a couple chats come through, but I haven't read them.
Yeah, Dr. Basu mentioned that you can send a paper.
Oh, great.
And he left a link in the chat.
Thank you very much. Yeah. So you could see our regression here where we examine recover as the outcome variable in our sample of companies with depressed market values. And we examine whether companies with some ex ante factors that make it more likely that they're performing a reliable impairment test are more likely to recover. Our variables for reliability, auditor quality, so we're going to look at Big Four auditor, analyst monitoring, so how many analysts are following the company, institutional investor monitoring, and whether they have lenders, so their leverage ratio. So that would be the monitoring channel, where if somebody's monitoring my decision, well, I'm more likely, I do a better job at it. That's the hypothesis. The private information channel is, well, okay, stock price is lower than book value. So the manager has to know something that investors don't in order for this non-impairment to be reliable. So in what cases are managers more likely to have some information that investors don't have? Our first guess was financial guidance. These are managers who are thinking about future performance maybe more carefully than companies that don't provide financial guidance. They're forecasting future performance, and so they have a better idea of what's going to happen in the future. Companies that have executives that are buying stock, so insider buying, so they think the market price is too low, and so they buy their own stock. Same thing with share repurchases. So stock prices at a good valuation, it's a good time to do share repurchases. Our last two have come out of workshops that we've done. So these weren't originally our ideas. The first is restructuring activities. So companies, maybe the stock price is depressed and managers are embarking upon a restructuring. And so maybe they have a better idea of what type of firm is going to come out of this restructuring than investors do. And the last
I
one,
believe Dr. Bus, we have a question
Okay.
on the slide.
Yeah, please.
He left a comment in the chat.
Oh, okay. Let's see if I
Scrutiny
can
by
see it.
board and committee. Dr. Bus, do you want to clarify
just
the
ask
question?
whether, the board of directors and the audit committee in particular would also be scrutinizing these decisions.
So this is something I don't know. I would almost certainly think yes. If I were a board member, I would scrutinize this decision to limit my own exposure to lawsuits. I would want to know that we performed a rigorous test. I'm not sure whether I can. I guess you would be suggesting I have governance variable.
Something like that.
So that's excellent. Yeah. Thanks very much. Governance variable is a good idea. Hey, Jonathan. Hi.
Hi, how are you?
Good. How are you?
So it's semantics, but the private information channel, why don't you think of that as just another signal? It doesn't really have to do with reliability per se. It just talks about, whether there are other consistent signals with a non-impairment.
That's a good question. So maybe the impairment is not the point here. It's insider buying predicts future returns.
I was really talking more about the label, that calling it reliability doesn't seem like the right label for what you're talking about with private information. It just
Right, because
seems
private information is a signal, is an observable manager action that could reveal the information just as well as the non-impairment. So I think you're saying it's not quite fair to call that private information.
In some cases.
What'd you say?
Non-action could also be a signal, just like you're saying a
I suppose
non-goodwill
so.
impairment is a signal. So,
But here I am calling private information something that investors can observe. I'm calling it private information. So I think I do have to be a little bit more careful about that. Now, they don't necessarily observe what's giving rise to these actions, but they can observe the actions themselves. Okay, so a lot of reviewers weren't quite happy with this regression. And so we tried to, we through workshops and our own thought, we tried to work out different cross-sectional variation we can take a look at. So I think one of the ones that I like, and maybe you can tell me whether you like it or not, is goodwill impairment tests are different from other impairment tests. So first of all, goodwill impairment tests are performed at a broader level than other impairment tests. Goodwill, you test it for impairment at the reporting unit level, which is it's either an operating segment or one level below a segment, which is, I'm calling that a broad level. You're testing a large fraction of your company for impairment. Compare that to PP&E or inventory. PP&E is tested at the smallest unit possible that you can calculate cash flows, that you can estimate cash flows for. It's called an asset group. So that's a more narrow level that we're testing for impairment. Inventory, it could be at the individual product level that you're testing inventory for impairment. So when market value goes below book value, sometimes we're doing a bunch of impairment tests. And the point here is that the goodwill impairment test is actually a stricter test in the sense that it's more directly tied to market value because it's a larger fraction of the firm. that we're testing for impairment. The other thing about goodwill impairment test is it's a strict fair value test. So when we're testing a asset that depreciates, there's a recoverability analysis where we can compare its book value to undiscounted future cash flows. And so the PP&E impairment test isn't as strict as just a fair value test. Florian, hi.
Sorry, but I think what you're saying is true, right? We're testing at the reporting unit or cash generating unit in IFRS. But shouldn't then be the number of segments or the size of the segment which is being reported also an indicator how close the impairment would be related to the overall company market value?
Absolutely. And this is where we started this paper. As you might have saw that Digital Globe, my example company, was a single segment company. So this is kind of an unfair example. And our first sample was only single segment companies because we wanted really the strongest signal possible. That was a small sample. That was 1,500 companies with those conditions. And it was overweight in banks, companies in finance industry, which have a lot of fair value on their balance sheet. And so we wanted to be able to expand to more industries and have a richer sample. And so that's one of the things we got rid of from that older paper is the single segment requirement. But we are being asked now to build that back in to the paper where we analyze what we want is a connection between market value and book value, and that's better when you've got a small number of segments. So I agree with you. Thanks. Yeah, Paul.
Yeah. Hi. Thanks for presentation. My question was basically what you were just saying recently, and that was the idea that the goodwill adjustment is for goodwill and not for other asset changes or asset impairments, right? So
True.
So that initial sort of selection criteria that MB is less than BB, that's taking into account a lot of other changes, right? Not just the goodwill change itself. So I'm thinking about what about additional liabilities that go into the books? How does that come into your selection of firms subject to goodwill? Are they eliminated or not? And then so I'd like just a response on that. How you?
Yeah.
Yeah. Just one other thing on top of that, and that is the idea that there is now two tests for goodwill is the qualitative and the quantitative, and does your research design take into account that? So those are sort of two separate questions. I'll listen to. Okay, thanks.
Okay, maybe you can feel free to chime in, if you want to discuss it a bit. But your second question, what we hope is that when we select only companies with market value more than 5% below book value, that the time for a qualitative assessment is we're past the threshold for a qualitative assessment was our thought. And in fact, when we do look at our companies, it doesn't seem like any of these companies, we didn't find any examples where companies are passing by the qualitative assessment or using the qualitative assessment to not do a goodwill impairment test. Your second one on the goodwill balance. So my understanding of the goodwill impairment test is the reporting unit includes goodwill, but it also includes all of the assets and liabilities of that reporting unit. And so we're testing the book value of a reporting unit for impairment. Right. And then the modern rule is to just imply whenever we estimate fair value, if the fair value is lower than the carrying value of the assets and liabilities of the reporting unit, we impair goodwill by that amount. Used to be a bit different from that, but so maybe we could talk more because my understanding is that the assets and liabilities of the reporting unit would be included in the book value that we're testing. Okay. So our hypothesis is that so if you have it, so okay, all these companies, they've got market value below book value. Our hypothesis is that companies with goodwill on the balance sheet did more work on that book value. They had to do more rigorous impairment testing on that book value than companies with only PP&E and inventory on the balance sheet. So what we're going to do is select the companies with market value at least 5% below book value, any company. And then we're going to compare the recovery rate of companies with goodwill to the same recovery rate of companies that don't have goodwill on a balance sheet. And next to this arrow is our hypothesis, which is among firms with depressed market values, firms that perform goodwill impairment tests have more reliable book values, meaning they're more likely to be confident that the market value will recover. And then finally, the last test that we'll perform is, this is the market reaction test. We're going to look at the market reaction to, we're going to start the announcement period the day before the earnings announcement and end it the day after the 10K. So it's kind of a wide period of time to have this non-impairment be disclosed. Florian, yeah, please.
Sorry, I mean, under use gap, you have really two approaches to figuring out if the fair value is higher or lower, right? And I think your example actually showed that, right? You have the market approach,
market
right?
versus
And the income
DCF.
yeah, exactly, the income approach.
True.
Can you figure out which approach was used, and would that make a difference?
We did. So which
because I
approach
mean,
was
because
used?
the market approach, you know, you look at comparable companies, and but it might be a little difficult to get out of the data. I accept that.
Well, we did so we collected, this is in section 5.5, we collected 500, I'm reading it right now. So we collected 500 observations in our sample. We found 74% use the income methodology and 40% use the market methodology. I'm not sure. So some companies use both. So I'm not sure what to predict in terms of which one is more rigorous.
Well, I'm not sure rigorous, but the income approach would obviously be representative of private information. The market approach, obviously, there's no private information in there. It's only in the income approach where you would have private information.
Yeah, you're right. Okay, that's really interesting. We hadn't thought about that. So let's take that into consideration. Thank you. Yeah. So the market approach, yeah, transactions are happening, and everybody observes those. So why would investors get the stock price wrong? Whereas if we're using a DCF, well, maybe managers are putting some of their own assumptions into there. Now, one thing we also observed, and I've seen a recent paper on this, is that companies, in addition to these fair value estimates, they'll also add a control premium on top. And that kind of would bias against our finding recovery if companies are just simply adding a control premium to avoid a goodwill impairment. And I don't know how subject that is to manager discretion, or whether that's based on observable transactions as well. Okay, so finally in this earnings announcement reaction, we're going to create this variable called signal, which is the book, where is the book value after the non-impairment compared to where the market value is. So our hypothesis is managers must have thought that that the fair value is at least book value, and that's why they didn't impair. And so if investors receive that signal and their reaction is proportional to it, we should observe a coefficient on beta 1 in the firms that don't have a lot of these reliability factors, and beta 3 among firms that do have a lot of these reliability factors present. And so we also might observe a intercept alpha if investors just kind of have a positive reaction to a non-impairment. And we might have a positive beta 2 if just the companies that are more reliable with those ex-ante factors have more positive earnings announcement returns. So getting into the data, it's a relatively small sample size. So we go from 2002 to 2019, and pre-impairment goodwill balance greater than 5% of market value, and then the market to book ratio below 0.95 is where we really lose a lot of observations there. And so now we have firms with significant market implied impairment of 3,747. And then within that 3,747 firm years, a non-impairment is defined as a goodwill balance greater than 0, so they left some goodwill unimpaired, yet their market to book ratio is still below 0.95. And the percentage of firms that meet that condition is actually quite high. So most firms are expecting the stock price is just temporarily depressed. At least that's what they're saying with their goodwill non-impairment. Here's the rate of recovery. So our dependent variable is whether stock price recovers within the next year. So each of these black bars is the percentage of firms that recover relative to the earnings announcement. So 7% of firms, the stock price jumps right back up above market to book of 1 at the earnings announcement. 14% of firms recover in month 1, 21% of firms. So this is now accumulating on the bottom percentages here. This is cumulative firms recovery, whereas the black bar is the percentage recovering during each period. So it seems like the first 3 months is where a lot of the action is, where stock price is recovering above book value. Within a year of the non-impairment, 47% of firms have recovered. Here's a big table of distributional statistics with our 47% of firms that recover. Our ex-ante reliability factors. So these are the factors where we think if a company has these present, we're more likely to trust the goodwill non-impairment. It's more likely based on reliable information. Sudipta.
You explore time series variations. So right after a bubble crashes, the stock market probably goes too far down. And so you might observe evidence of potential impairments, but if the market,
Absolutely.
the market is going to rebound as it generally does after those, then
Yep.
you should not treat it as a real signal, right?
Yeah, just as you said, in 2008, so this is the year in 2008, and stock price recovering in 2009. We have 633 observations in that year alone, and we have 56% of those companies recovering. So you're exactly right that, when that crash happened in 2008, that the non-impairments are telling investors, look, this is just a temporary decline.
So, and this is just an aggregate this thing, but there could be sort of intra-industry things as well going on. But right, industry.
Yeah, so I think we don't do year by industry, but in terms of industries, you're right. There's quite a lot of variation that we observe by industry, where the average recovery rate is 47% here. Some industries recover at very high rates. So this is how many companies do we have? 48 companies. Pharmaceuticals, 67%. So we don't exactly know what to conclude here. We do a test based on if there's a lot of R&D, there's a lot of valuation uncertainty in that industry, then it might be more likely that managers has some private information that they're basing their impairment decision on. So we have this variable for R&D industry, and we find that is positively associated with the recovery rate.
If I look at the first and third line, it looks like the financial sector and the 2008 crisis again.
Yeah, so banks and insurance recover at very low rates. They have a lot of their balance sheet at fair value. So yeah, I'm not sure how to do a good job explaining why that rate is so low. My first thought was that the book value just kind of hovers around fair value, and so you don't observe significant recoveries. But I didn't have a better explanation than that for the low recovery rate of banks.
So a question for you, please.
Yeah, please. Yeah.
Do you also control for prior impairments that companies did?
We don't. So yeah, it's true. I think that some companies impair every year.
Every few years, but
I'm not sure. I'm trying to think. What would that be a control for? So
I think if you find a company that in the past impaired and this year decided not to impair, although the book value was higher than market value, that's a stronger signal that
I see.
Expect to see a recovery.
Yeah, that would be more surprising if a company that usually has no problem impairing decides not to. I could see why you'd say that'd be a stronger signal than a company that always is trying to avoid the impairment. Now, it's one thing I want to make clear in our sample. Here's our sample size of 3334. 18% of companies in our sample impair. impair goodwill. But they didn't impair it to zero, and they left their market value at least 5% below book value. So some of these firms actually are impairing. Our controls is market to book ratio. So how far do you have to go to get above book value to recover? Yeah, Sudipta.
So if there's, let's say 5% of the balance sheet is goodwill and you have a 5% decline in the stock price or 5% gap, if you were to spread this evenly, this would be like what, a 0.2 of assets, 0.2%.
Okay.
So is that material?
So
That's another
wait, could you
criterion
explain
in
that to,
impairment.
I think I didn't quite catch the math that you were implying there.
So
Could
you
do
said
one more
that
time?
5% is goodwill, right? 5% or more is
5%
goodwill.
of market value. Yep.
Yeah. Right.
And I'm saying market value is quite low. So you're saying this could actually be quite
So
small
now the
goodwill.
question is, if there's a 5% gap, the other 95, the market to book ratio is 0.95. If we assume this is spread evenly across all the assets on the balance sheet, then 0.5 times 0.5, 0.05 times 0.05 turns out to be a pretty small number.
You're saying the impairment is spread across all assets on the balance sheet?
So the question is, how do the auditors or managers assess materiality? So one of the criteria for the impairment is also whether it's material.
Yeah, true.
So you have not, in my mind, assessed materiality.
Well, here would be my statement on that. So by rule, well, I don't know if I should say by rule, but the guidance says that the last thing you do is your goodwill impairment test.
Yep.
So these companies, before I
So
even do
have they
sample
done any other
construction,
impairments, for example?
they've already done their impairments of all the other
Can you
assets.
measure that? Can you see that?
Sometimes they disclose it and sometimes not. So
Well, so
I will.
CompuStat should have the PP&E, right? So CompuStat has PP&E impairments from 2001.
Do they?
Yeah, just like the goodwill one.
So they've got a variable called WDP, which is write-downs pre-tax, but that could be intangible assets or
There's long-lived assets, and it's usually, but regardless, I mean, you care about.
Yeah, I can get. I mean,
other
audit
assets
analytics.
or not,
Yeah,
right?
audit analytics has anytime you disclose an inventory or PP&E impairment, audit analytics captures this as well. So that's something we can very easily do, is incorporate whether they've already impaired some of their assets.
Yeah.
By the way, Harry, Dr. Basu left a comment in the chat regarding the paper on goodwill versus PPE impairments.
Yeah, fantastic. I'll make sure to copy and paste all of the comments in case you
I
don't get a
also
chance to bring
copy paste them. I can send them to you.
All right, thanks. So I've been kind of hopping around the slides here, but we construct a summary variable of these reliability factors, and we call the variable reliable. Now we may have to revisit the title of this. We've renamed it a couple times. Maybe we'll revisit the label reliable. But here's how we construct that variable, where companies with more reliable factors are given the variable reliable is set equal to 1. And firms with less reliable factors, it's set equal to 0. So what does more reliable mean? Big Four auditor, at least more than 3 analysts, higher than 48% analysts, institutional investor ownership, higher than 16% leverage. These are all medians. They give financial guidance. Insiders are buying stock. They're doing share repurchases, and they're doing restructurings. And if firms have more than 4 of these conditions being true, we set their variable equal to 1 for this. Looks like a more reliable company doing a more reliable impairment test. Am I missing any questions at the moment? Okay. So that's just a summary measure that we try to come up with to not look at all these factors individually. I don't think anybody, you feel free to ask a question on this one, but this is just a correlation table for reference. Okay, here's by industry recovery rates and by year. And here's a regression where we try to predict recover. So the outcome variable is an indicator variable for whether the stock price recovers above book value. So this is a 5% below book value. Does it recover above? You can see our controls are really doing a lot of work here. Market to book is how low is the market value relative to book. Underwater is how many days during the past, I think it's 6 months, was the stock price under book value. Cash flow is operating performance. Sales growth is too, and size here. Yeah, Sudipta.
Do you know what's the FASB guidance to banks on when they should impair traded securities?
Now, my memory is saying when it's an other than temporary impairment.
Yeah.
Which I think was kind of the basis of your first question, right? Which is it's got to be an other than temporary impairment.
Under US GAAP. Yes.
Right. I guess that's what this underwater percent may be capturing. In my mind, how long has that stock price been underwater? Now you might say 6 months isn't long enough to do this analysis. Is that what you'd say?
So the guidance under US GAAP is that the stock price has to be continuously below market for 1 year and below market by 20% continuously.
Is it really?
Yeah. So in EITF 0301, the FASB tried to reduce that from 20% to 5% and lost. So this Catherine Schipper describes this as the biggest defeat for the FASB during her tenure at the FASB.
Wow, this is a huge
bigger than stock options.
Okay, so well, let me apologize for not knowing that. So I will look up that EITF.
I'll put it in the chat.
Yeah, inform myself more on that. So thank you very much. So here we have Big Four auditor, number of analysts, institutional ownership, and restructuring activities being positively associated with recovery. And here we have our reliability factor being positively associated with stock price recovery, as well as R&D industry. Okay, goodwill versus non-goodwill firms. So here's our sample. This is 3334. That's our main sample of companies with goodwill on the balance sheet, market value below book value. And then we have a control sample of firms without goodwill. And the hypothesis is, well, these guys, the firms that have goodwill, had to perform a more rigorous impairment test than the guys that didn't have goodwill. These guys are just doing the undiscounted cash flow test. And in some cases, they're testing inventory for impairment. And so it's not as strict that they're looking at that book value for impairment. And so we're going to do entropy balancing on these two groups, where the companies with goodwill are balanced with the companies that don't have goodwill on the balance sheet. So we're balancing on market to book, on how reliable, on all those reliability factors in that reliable variable. We're balancing on their cash flow operating performance, their sales growth, size, and underwater percentage. So you can see these are balanced because they've got the same weighted mean. And then the question is, do they have different recovery? When we're balancing on these characteristics, do the goodwill firms have a higher recovery rate than the non-goodwill firms? And so we find that, as you saw before, we have a 47% recovery rate in our goodwill firms. And it's only a 35% recovery rate for companies without goodwill. So these are just the PP&E, the companies without goodwill. So they've got other assets on their balance sheet. And here's our regression where now the variable of interest is this goodwill variable. Are companies with goodwill on their balance sheet more likely, among companies with depressed market values, are companies with goodwill on the balance sheet more likely to recover? And the hypothesis is that they had to test that book value more rigorously. So that positive coefficient is consistent with that idea. And then the other idea we got actually on when I did a workshop at Columbia, I got this idea. And so I was given this idea. And so this idea was, why don't you test a different threshold? So right now we're testing the market to book equals 1 threshold. And we argued that, and so it's true that we would agree that that's a particularly relevant threshold. Once market value drops below book value, that impairment test is likely to be happening. But if market value drops below 1.5 times book value, it's less likely to us that that's triggering a goodwill impairment test. So the companies in this treated column, their market value dropped below 1. And so we think they're performing a goodwill impairment test. In the treated equals 0 column, these companies' market value drops below 1.5. So we think it's not necessarily true that they're performing a goodwill impairment test. We are going to balance these companies on the return they would need to exceed the threshold of either 1 or 1.5. We match on those, sorry, we don't match, we balance on those reliability factors, operating performance, the same variables we're balancing on. So the companies that fall below the market to book of 1 ratio, so this is a smaller sample. So, okay, this is a smaller sample because we need to make sure that the return needed to get back above the threshold is similar across treatment and control. So we've got a subsample here of our goodwill non-impairment companies. And it's a subsample with a market to book greater than 0.67 and less than 0.95. And so they recover 62% of the time. That's a higher recovery rate. Whereas the companies between 1 and 1.425 market to book, they only recover above 1.5, 27% of the time. So there's a higher recovery rate when your market value drops below book value than when your market value drops below 1.5 times book value. And here's the...
So the firms with goodwill on the balance sheet have more volatile stock returns than those without?
What'd you say?
Do firms with goodwill on their balance sheet have more volatile stock returns than those who do not?
I don't know the answer to that question.
But that has implications for the temporary.
Yeah, because volatility
implications for the recovery rate.
Absolutely, because recovery just asks, does your stock price recover above book value? So volatility is a factor there. At some point, so we have, maybe it was in a robustness test or something where we were asked to, and we did control for volatility. But I agree with you that should be in this main table, is a control for the volatility of the stock price and an analysis of whether these companies have different volatility, have higher volatility than others. So thank you very much. Yeah, we will add that as a control. Okay, finally, in our investor reaction test, if you remember the Lee et al. Paper, they examined investor reactions to non-impairments, but their non-impairments, those companies had market to book ratios exceeding 1 for the median non-impairment firm. They already had a market to book exceeding 1. So it wasn't clear to us that investors were expecting impairments in the sample that they examined. In our sample, we think investors are more likely to be expecting impairments. So market value is at least 5% below book value. And so do we observe a positive return when the non-impairment is announced? The first regression is just the intercept, and we observe a positive intercept here. It's a 1% return when the non-impairment is announced, which would be consistent with a positive reaction to the non-impairment. We're controlling for whether an impairment was recognized and earnings and sales surprise and guidance surprises at the earnings announcement. And if you remember, this earnings announcement period starts before the earnings announcement and ends after the 10K. Okay, signal, remember, is that's the variable that captures the percentage difference between book value and market value. So if book value is taken to be the lower bound of what managers think the company is worth, we might expect stock price recover to book value when the non-impairment is announced. It does not. It does for 7% of firms, but it doesn't on average. But we do observe that the market reaction to the goodwill and non-impairment is proportional to the impairment that was expected, but not recognized. And the stronger reaction is observed among firms with factors that suggest the impairment test was more reliable. So that's what this interaction term suggests, that when the firm has a lot of those reliability factors present and they tell you goodwill is not impaired, then the stock price response to the non-impairment is correlated with the impairment that was expected but not recognized. So I really appreciate this conversation. I learned a lot, and I've got a lot of notes to help improve this paper, so I appreciate your contributions very much. In summary, we think simply contrasting impairment and non-impairment firms is not the ideal design to examine the specific research question of whether goodwill non-impairments can convey positive private information. We find some evidence that these smaller than expected goodwill impairments are justified about half the time, 47%. And goodwill impairment rules seem to force firms with depressed equity values to have more credible reasons to leave book value unimpaired. And that's particularly true when book value falls below, when market value falls below book value. We also observe that investors react positively when this decision appears to be more credible. So thanks again. I really enjoyed this presentation, and I wanted to inform you about the next accounting design project, which will be on December 2nd. That's Tuesday at 1 p.m. It's a different starting time than before. Joseph Garikos is presenting on distinguishing accruals from real earnings management. So thanks, everybody. Appreciate it.